and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most.
Welcome to the Open Treasury Podcast. This is Craig Jeffery. I'm sitting in Push Pendra's seat today. Push is off for much of December. In the guest seats today are two stalwarts of the Open Treasury Podcast, Ben Poole, who's a writer for CTMfile, which is a Treasury media outlet, and Paul Galloway, a senior advisor at Strategic Treasure, which is a consulting and research firm. Welcome to the Open Treasury Podcast again, Ben and Paul.
Thanks, Craig.
Yeah, thanks for having us again, Craig.
Yeah, so this week we're talking about 6 stories. We're discussing them. There's 4 themes. The themes are currency FX, the economy, and we're focusing on Turkey and the UK. And from a tech standpoint, we'll look at genAI and is this taking away everybody's jobs. And then finally, we'll wrap up with a view on ESG. Listeners can see the show notes for links to the articles. Feel free to visit ctmfile.com. Ben, I'll start with you. On currency and FX, the main article was the renminbi, the Chinese yuan, retained 5th place among the most active global payments currencies. I'll just say a few things about this. The USD and euro dominate payment volume. It's greater than 70%. RMB is less than 5th, and that sits at less than 3% of this activity. So, are the conversations that we've heard throughout the year about the USD no longer being the dominant trading or the dominant reserve currency premature? Is this too much of a projection? And is this a topic that's really, at present, only relevant for economists in the medium-term horizon? Do treasurers need to care at all? Go ahead, Ben.
Yeah, so I think it's interesting to kind of reflect on this Swift RMB tracker. And obviously, as you just said, it's kind of the 5th ranked global payments currency. But last October, it was also the 5th ranked global payments currency, slightly lower share, like 2.13%. If you go back a couple of years, even before that, it was in 6th place, just below the Canadian dollar. So it's managed to overhaul Canada in 3 years. But if you look at the US dollar in the same time frame, October 2020, USD was over a 37% share of the global payments currency. And today that's 47.25%. So you could argue, from one perspective, that the RMB has kind of hit a plateau. It's quite easy to jump up the top 40 when you're new, it's a new release. But I think people are kind of getting used to RMB, and it's not suddenly taking over the world, and the dollar, as those stats show, has kind of even increased its importance worldwide. I think for companies where China is a key part of the value chain, you could argue that it's increasingly practical to deal in renminbi. China has taken some steps to facilitate the use of the currency in international trade settlements, including preferential terms for trading partners if they're using the currency through things like reduced documentation requirements. And there's been an improvement in offshore renminbi liquidity in recent years, plus things like the introduction of cross-border cash pooling that started in a pilot program a couple of years ago, which has allowed multinationals to simplify their cash management operations by integrating RMB funds and transferring them between their domestic and foreign subsidiaries. And that particular pilot has been expanded since to include a quota system for cross-border transfer, so like removing the need for individual approvals and giving eligible multinationals a bit of greater flexibility. So I do think that any company that has significant operations in China, it does make sense for treasurers to look at the currency. But as yet, there doesn't seem to be much threat to the RMB becoming a rival to the US dollar as a global reserve currency. So I think maybe that's been slightly overcooked in some places. One thing that could perhaps change that, I would note, in the future, is that China is ahead of the curve on the development of a central bank digital currency and the internationalization of the digital yuan, or like the eCNY, it's also known as. That could be something that's quite transformative for global trade. There's the project mBridge, which was founded by China, Hong Kong, Thailand, and the UAE. And that's the largest cross-border CBDC initiative And obviously the ECNY it's years ahead of other major CBDCs. So that's where the potential perhaps for the Chinese currency to have a bigger impact on the global stage comes from, rather than anything from opening up RMB has to this point.
Excellent. Some good comments there and calibration of that. Paul, I'll let you comment on that, but I also wanted to bring something else into the mix. European and North American corporates were stung by $20 billion FX loss this period. That was an article there, and I guess I'll let you jump on that, and I'll also give you an opportunity to get back on this. You think about the economies. The economies are over 40 trillion, and so does a $20 billion FX loss, or about 0.05% really sting? Is this much ado about nothing, or is it, if it doesn't sting in aggregate, is it more impactful for individual companies?
Yeah, Craig, I think Ben did a great job talking about the RMB and where USD is in terms of trade currency. I agree with the comments that he made. He hit all the points I would have hit. I think about FX losses relative to what we've seen in the prior year. Volatility's come down, but we have seen hedge ratios go up. I think that treasurers are taking note that they got to look at their balance sheet and where the risk is, and they got to make sure they're hedging out there where applicable. I can remember a day when hedging a few years ago, treasurers were rather light in terms of monitoring their FX positions for some organizations, depending on how broad and deep the global footprint is. Obviously has an impact. Some organizations chose to accept volatility when it was really low. So we saw low hedge ratios. That's not been the case in recent time. Hedge ratios has definitely jumped quite a bit. It's just interesting, the article pointing out the Canadian dollar is most impactful currency, and it's not something that perhaps people would think just naturally off the top of mind that Canadian dollar would have an extreme amount of volatility. But obviously it has had quite a bit of impact. These are real dollars, and this is stuff that impacts bottom line earnings, and it's something that treasurers need to keep an eye on. They can't take their eye off foreign currency, need to monitor what's going on with volatility. Talk about tailwinds and headwinds. I think there's still some headwinds out there, Craig. I feel like, some of the data continues to be mixed bag in nature. We don't have everything pointing one direction or the other. You get some good news one day, you get some bad news the next day, and we just continue to see an impactful amount of volatility out there. So I think from a trading standpoint, treasurers got to keep their eye on what's going on with FX. And definitely when you think about the top 5 industries pointed out in this article, it really makes sense. These are manufacturers, these are people that are somewhere along the trade finance or supply finance chain. And this is hard materials. It's specific type of parts that are needed to build things that these organizations sell as a product. And when you have a lot of volatility in FX, it certainly can impact the supply chain. So I think thinking about how they finance and fund that, along with hedging, I think will help treasurers manage that a lot better.
So Ben, it sounds like Paul's saying volatility is to some extent in the eye of the beholder. What are your thoughts on this?
Yeah, I'd absolutely agree with that. And in fact, you can look at the Kyriba Currency Impact Report's previous findings. That's a lot of money that we've lost in Q2 this year. But if you go back to Q2 last year, that was over $37 billion. And even in Q3, $47 billion. So this year, $22 billion in Q1 and $20 billion Q2. Clearly, it's a little bit less volatile this year. Perfect time, perhaps, for treasurers to review, analyze, and maybe upgrade processes, policies, technology in order to protect earnings. Hedging, as Paul said, is a fantastic way to mitigate FX risk. Some companies might want to start hedging, and those that are already hedging might want to go to a greater level of hedging on their exposure in order to protect the bottom line. I think also locking in rates that are slightly shorter, maybe like 5-6 months, rather than longer dated FX forwards, can give an extra level of flexibility for corporates. If the market suddenly goes in an unexpected direction, they're not left holding the bag in that case. So yeah, I think there's a lot to be thinking of, but hopefully it's not quite as bad as it has been in the previous year.
It's not calm. There's not a storm. A little bit of chop in the water. Pay attention. Good points. I'm going to get back to you, Ben, on our next topic is the economy, focused on two articles, one on Turkey and one on the UK. Title for the Turkey article is Turkey to continue monetary tightening but at a slower pace. And the second one is UK growth to continue weak but avoid a recession. Turkey looked at raising their central bank rate to 40%. They had a little over 61% inflation rate in 2022, or last month rather. That's what the inflation rate was, and it was 72% last year. Is the Turkish lira a failing or failed currency? That'll be one question for you. The next is for the UK economy, bad news, good news is how I see it. Bad is it's super sluggish. Good, 2023 looks to avoid a recession. So positive, just barely. Yeah, so what's the impact on the European and global economy? What are some of the things to watch out for? So we'll start with you, Ben. Maybe you can start with a little bit south and to the east in Turkey, and then head home to the UK.
Yeah, Turkey's a very interesting case. I mean, most of the monetary policy and inflation stories that I write about tend to be regarding the Eurozone, UK or US. I think all three of those areas have tended to follow a similar path, both on inflation and interest rates, and we react extravagantly to every 25 basis point move one way or another. Obviously, Turkey's inflation rate environment is wildly different. I do think that the country is obviously still of great interest to corporates. It's strategically important, I think. It's kind of the gateway from Europe to Asia. It's a NATO member. It's very keen, or has been at least, on joining the European Union. But I think for treasurers managing operations in Turkey, I've spoken to one or two, and they kind of made the point that you need a different playbook to make the most of cash management in that country. So things like cross-border cash sweeps or intercompany netting, they might be possible, but the way that you do them might have to be in a slightly different manner to in other countries due to the regulatory environment in Turkey. You know, it's possible to have foreign currency bank accounts in the country, but banks that are holding those accounts have to buy Turkish government bonds, for example, to go against those balances. So that might be quite touch and go whether any of a treasurer's banking partners will actually want to do that for them. So that might mean that corporates have to use more local banks than they're usually comfortable with just to get business done. So there's a few considerations, and you know, the currency, I'll be honest, I'm not an expert in Turkish lira and what that might mean or not mean, but certainly it's getting hammered at the moment. But I think there are also chances, perhaps if you're short on lira, then the depreciation might actually give you a net positive. So that's one potential point. The UK, like you say, nothing as dramatic as Turkey. It's kind of been in limbo this year. No recession, but growth of 0.1%, 0.2%, and then no growth in the first 3 quarters of the year. I mean, that's not pulling up any trees, is it? So the headline, seasonally adjusted S&P Global Flash UK PMI Composite Output Index, that registered 50.1, which was up from 48.7 in October and above the crucial 50 no change value for the first time since July. So maybe a few tiny green shoots of recovery. That composite PMI was dragged over the 50 threshold by the services sector. Their flash PMI was 50.5, which was a 4-month high. And manufacturing still in the doldrums a little bit, showing signs of contraction at 46.7. But that itself was a 6-month high, which just kind of shows you where it's been for most of this year. One thing I would add is that inflation remains quite sticky. You know, there's strong wage inflation in the UK, and the need to pass on higher fuel costs to customers continued to push up average prices in November. So there's a little cocktail of one step forward, one step back, perhaps, going on in the UK.
Some minor end of the year holiday season, a little bit of exuberance there, perhaps, pulling it over the end. Paul, wanted you to see if you wanted to weigh in either of these two countries and the economies or the broader impacts.
Yeah, I think these are two divergent articles here. You got one with a country that It's running at a rapid rate of inflation, high interest rates. It'd be interesting to see the impact of the latest increase, which they bumped up to 40%. That's just insane to think they're at that level right now. But you got to think at some point these high interest rates are going to cool the economy down and get things in a better place. And they're talking, mid 30s. Boy, that'd be great to get inflation down to mid 30s. Well, that's still extremely high. Turkey has a lot more ahead of it before it gets to a better place. It's got to continue to work on that monetary policy for sure. You can't continue to run a country at that rate. It's just not something that works long term. So have to keep an eye, especially if you're a treasurer that's doing any kind of business in Turkey or you're trading the lira. You got to keep an eye on that. Obviously, it's getting pounded, as Ben pointed out. So if you aren't keeping your eye on that, you definitely should. UK, I don't think there's much surprise in terms of what you see is going on there in the economy. It seems that their rate hikes have taken hold to a point where things had settled down. They're starting to get back to maybe a little bit of a norm. Is this going to be a soft landing? I suspect time is going to tell us whether that's actually going to happen or not. So I guess we'll see on the UK side.
Yeah, earlier in the year, it seemed like the UK might be in recession. Germany looked to be definitely in the recession period, and we looks like we're finishing out with the UK slightly positive. So that's the economy. Let's turn to technology. Paul, I'm going to ask you on this first. This is about generative AI. This is a hot topic in many circles, certainly in Treasury. The headline is 73% of financial service execs expect genAI will eventually take their job. So are we all going to lose our jobs? Instead of everybody losing their jobs, will there be impacts, and why? Where will those impacts be? Will they be just on the individual finance side? Will there be impacts on the corporate side, and to what extent? And is this going to generate job losses and job gains, particularly on the corporate side? So maybe we'll add to that. What's your advice? Retire, hire more AI-capable people, break the machines like the Luddites of old? What do we do, Paul?
Yeah, that's a great question. I got to imagine, Craig, some folks are sitting there looking at, where they're at position-wise for retirement. And you're probably going to have some folks that are going to say, hey, I'll take an early package if you offer it to me. And that's fine. That's okay. I think if I'm a leader in a corporation, I want to make sure that I'm hiring people that are AI savvy. I also think breaking the machine is a good thing. Change is not necessarily bad. Doesn't mean that it's not painful. People losing their jobs, or maybe they're right sized or shifted into another role. And that's not necessarily bad. In the short term it is, but long term it may be much better for organizations and the people that are involved in the role, treasury, accounting, something along the way, corporate finance, whether you're doing forecasting at FP&A. I think these tools are going to become really valuable. And if you're a person that can position themselves as an expert in the use of AI and how you can integrate it into your technology, and you can make things more efficient, provide more visibility, provide that strategic niche information that helps decision makers drive the company towards its strategic goals, then I think you become more valuable. So I think, is there a potential impact on jobs? Yes, but I think there's a lot of upside opportunity here. So my hope is that executives, leaders in the Treasury arena will look at this as an opportunity versus it being more of a foe.
It sounds like you ended up with run the machines, not break the machines. Ben, what's your take on the growth of GenAI? It's certainly been extensive, and it's the new revolution. I think many people are talking about, like the industrial revolution of not too many decades past. It's impacting many areas of business, certainly different areas of finance, including corporate finance, corporate treasury.
Yeah, it's definitely very much in the zeitgeist of 2023. I think all these end-of-year reviews that are about to happen and come out on TV and on websites, I don't think you'll be able to move for talk of genAI. But I don't think it will take everyone's jobs. I think some people can make the leap and assume that AI can do absolutely everything that a human can do, but I don't believe that particularly. But it is incredibly useful, and it's kind of another level of automation, particularly in the Treasury world, when you think about being able to accurately predict things like a company's cash requirement, for example. So the ability to increase the accuracy around that, particularly in a high interest rate environment, that's an advantage. Even if it's just going to knock the forecast a further 2 days further out than the treasurer can do right now, that's going to help corporates save a lot of money on short-term borrowing costs. And that's something that you can do with this technology today already. So it's an area to kind of start, experimenting with, seeing what works for your organization. Do you need to update your policies? Do you need to update your tech stack to make it happen? All questions that treasurers should be thinking about. And I'm sure a lot listening will already have thought about this and be in review or have completed reviews. But I do think it's not going to take over from the treasurer. It's more like a sort of a co-worker that can help the treasurer. You still need the treasurer there to sort of monitor these results and make the call on the big decisions. But that's a lot easier to do when you have these much more detailed and accurate data positions delivered much faster. So massively generalizing, I think there's probably two approaches that people could take with AI, either learn how to leverage it and how to help make themselves and their jobs better, or ignore it, or even fight it, like you were saying, smash the machines. But if you look at the direction of travel, it kind of appears that those that are going to do that are probably going to lose the fight. So anyone that's maybe afraid for their career should consider that when thinking about what to do with this technology. Just look at what AI might be able to do for you and how you can use it as a tool to boost your performance and also your organization's performance as well.
It becomes really difficult to smash machines that are running in the cloud in a place you don't know versus the Industrial Revolution. Some really, really good comments there. I think I'll just add a few comments. I see Treasury as they tend to be very understaffed. There's piles of more analytical work that they've wanted to do, and this gives them the tool and the lever to accomplish that. So I think particularly in that area, it's at least a net neutral jobs, most likely an increase because the lever generates more gain. So we'll see. We'll do some follow-up on this. This brings us to our fourth theme, which is ESG. The main article is ESG investors are committed to a transition. If you read through the article, in the comments, it seems that ESG, environmental, social, and governance, it seems to be experiencing a bit of a pause or a minor retreat. Now, after many years, it's moving in one direction towards greater adoption, more movement. The environment, a little bit heavier, certainly heavier in the UK than other areas. Governance, a little heavier in the US. But this is showing a bit of a pause or maybe a minor retreat. Most are saying they're not experts. 3% say they're experts. 15% say they have good knowledge. So a huge portion, there's a knowledge gap. Given this long secular trend of increases, will this pause end and start back on that trend? Where and why? The UK, broader Europe, the US. Ben, why don't you start us off, and then Paul, if you have any comments, let's hear them.
Yeah, thanks, Craig. I think maybe the issue that it's run into is the term itself. ESG is perhaps, past its sell-by date. It smushes together three huge and sometimes quite incompatible topics. The E and the S look at different types of ways to serve society. The G tends to focus perhaps on how we generate returns. So these might not all be compatible within one policy. And I also think that maybe ESG as a term has become a bit detached from the good work that happens underneath that banner. It's basically a marketing phrase in several places. So with that, it has been misused. There's famous cases, of course, of greenwashing and things like that, which dent trust and belief in the brand of ESG, if you like. So it's almost become too big as an acronym, a 3-letter acronym. I think for investors, they need to get under the hood of the companies and funds that badge themselves as ESG to kind of really understand what that means in practical terms, what their KPIs are and how these are reported on. it's not enough for them just to invest because they see the ESG acronym attached. But I think this story does show that investors are also increasingly putting pressure on corporates to act in kind of a sustainable, a social, and governance considerations manner at the forefront, kind of no matter what you call those three combinations. Treasurers as well, obviously ESG can be a very serious topic, particularly if you think of something like supply chain management. That's an area where there's lots of regulations and protocols. I'm thinking of like Scope 3 of the Greenhouse Gas Protocol, which covers all emissions outside of a company that it's indirectly responsible for up and down its value chain. Now, those GHG scopes 1, 2 and 3 are the basis of mandatory reporting in the UK at least. And Scope 3, often for a company, it will have by far the biggest impact, but it's also the area that the company itself has the least control over in terms of addressing how these emissions are managed. So they have to try tackling this issue is essential, to reach certain net zero commitments that will be set way above the treasurer's pay grade within an organisation potentially. So I don't think the individual topics within ESG are slowing down, mainly because of the global and national regulatory requirements that demand that they don't. Germany brought in a supply chain due diligence act at the start of this year for companies with more than 3,000 employees, I think it was. And that act puts the onus firmly on those companies and their directors to take responsibility for the actions of their supply chain partners. So I think, that's just one example of corporates still having to, have their eye very much on these different areas of responsibility and accounting for how they act as a company. And the treasurer has quite a key part to play in that, I would say.
So thanks, Ben. Yeah, Paul, this perhaps maturing or deepening of the views, there's the commitment and there's also the concerns about it. Any other thoughts you want to add to the discussion about the ESG trend line here?
Yeah, I think, Ben hit on something that is probably part of the reason I think investors find this challenging, trying to get the knowledge base in place and understanding of, what ESG encapsulates. I think of it like perhaps ESG is really akin to an industry, and the E, the S, and the G separately are more like a sector. If they're able to break it down like that, perhaps they'll be able to more easily get their arms wrapped around it. But it seems to be really problematic for investors. They're not getting that knowledge base they need. There's also quite a bit of divergence in thought process. This article points out the difference between men and women and how they view sustainability as an investment. And it's interesting that they're somewhat divergent. And later on in the article, they talk about German investors. They're one way or the other. They're either hot or they're cold. It's just interesting to see the diversity in thought process. When I think about just investments as a whole, as an investor, I'm looking for the best risk-adjusted returns I can get. And I think there's still just not enough knowledge base out there from an investor standpoint and the understanding in place to see how it fits in their portfolio to generate that extra risk-adjusted return that they require. And so if the industry, that arena, is able to deliver that and investors are educating themselves more, I think this becomes a lot more important again and people will start making those investments. I think it's more of a pause. I don't think it's necessarily, maybe it's a minor retreat, but I don't think the investment in that area goes away. I don't think the expectations that corporates aren't going to have an ear and support for sustainability. I think that's the trend, more of the norm. So better risk-adjusted returns, I think that's to be seen.
Excellent. Thanks for all of your comments on that. Those are the four themes we had. Currency and FX was one. The economy, particularly focused on Turkey and the UK. Technology for genAI. And the fourth one was environmental social governance, or ESG. So I'd like to hear what you think is the most important. It could be a story or it could be a theme of the past week or the past month. And explain your reasoning. I'll begin with you, Ben. What's top in your mind?
Well, I just wanted to piggyback off that last story, actually, and note that today we've had the very first transatlantic flight by a large passenger plane powered only by alternative fuels, taking off from Heathrow in West London, headed for New York's JFK. And I think it kind of sums up some of the issues in the wider ESG debate. The fuel they're using, it's powered purely by sustainable aviation fuels, or SAF, if you'd like another acronym. And that's kind of made up of a cocktail of crops, household waste, and cooking oils. And this particular flight has seen a Virgin Atlantic Boeing 787 filled with 50 tons of SAF, with two types being used. 88% of it is derived from waste fats, and the rest from the waste of corn production in the US. Planes do still emit carbon when using SAF, so it's not a panacea for the problems of the airline industry. But an industry spokesperson in a piece that I was reading says that life cycle emissions of these fuels can be up to 70% lower. There are challenges, of course, as well. This is a new fuel source as things stand. But the main challenge is that there's not enough SAF in production today, which can push its price up compared to traditional jet fuel, which, is a headache. Are we going to spend money on, replacing what we've done just to try and be a bit more green? And obviously that'll reflect in flight prices being higher for the end customer. So SAF isn't an end game for carbon reduction in the airline industry. The UK government plans to require 10% of aviation fuel to be SAF by 2030. But perhaps it's just, it's another step along the road. It's a bit closer to net zero. And at least, there's some experimentation happening. So hopefully it lands okay now that I've mentioned it on the podcast.
I hope so too. I wonder what the exhaust smells like. If they're, does it smell like bacon or something?
Oh, it's probably like if you're outside a fish and chip shop in England, it'll smell a bit like that, I imagine.
All right, your top theme, Paul.
Looking out here, when I think about FX volatility, I think treasurers just need to keep an eye on that. They can't take their eye off the ball when it comes to currency, especially in the environment we have now. I think there's too much uncertainty. Just reading out there, in this past week, there's been a lot of talk around, from a U.S. perspective, what the Fed's going to do. And there's wagers on both sides. They're going to not raise rates. They're actually, some banks out there are proposing that rate cuts are going to happen the first half of next year. So there's wagers being that it's going to be later in the year. And so we've got some divergence in what's going on out there. So I think from a treasurer standpoint, two things I keep my eye on are FX and interest rates, because I think we're going to have some rockiness over the next 6 to 12 months as we get more information, more data that supports decision making. I think it's still a mixed bag out there. Consumer confidence in the U.S. is kind of stabilized. That will remain to be seen if it stays that way. We have seen out there that there's been a lot of, from a consumer standpoint, there's been a lot of purchases that have been made out there for the holidays, but these purchases, a significant number of them, have been buy now, pay later. And, are they going to make good on the pay later? What does that mean from an economic standpoint if they don't make good on that? So I just feel like there's still some things that treasurers need to make sure they follow closely and understand where things are at, where things are trending, because it feels like there's just still some rockiness and uncertainty ahead of us.
Great. Ben, Paul, thank you so much. And to those who are listening, thanks for joining us on the Open Treasury podcast. Until next week, thank you.
This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.